There are 5 fundamental things you need to consider before you short sell stocks. In this video, I'm going to explain exactly what short selling or shorting is, while giving some things to consider, as well as relatable analogies to further break this down and provide better comprehension, as well as the tools to articulate it to anyone who may ask you how to short sell. So for the fundamentals, just to briefly go over, fundamental number 1, what is shorting or short selling? That's essentially you betting against a company. You're betting on this company to decrease on value, and you're going to profit on that decrease in value. Fundamental number 2, understanding margin and margin calls. Margin trading, trading on margin, putting that money down in order to short sell while being subject to margin calls issued by your brokerage in certain instances. Fundamental 3, short squeeze, that rapid increase in that price. What causes it, why, and why it's a big risk. Speaking of risk, fundamental number 4, buy-in risk, how it ties to margin trading, margin calls, as well as short squeeze. Which brings me to fundamental 5, and that is risk reward. The same thing you ask yourself with everything in everyday life. Is this worth the risk? Here's a couple analogies to consider to either educate you or already enhance that knowledge you may have on the subject of short selling. Short selling and buying to cover is essentially the inverse of long positions and then selling at a later date. With short selling, I like to think of it as you're taking out a loan with your brokerage on a specific amount of securities or stock of a company. You get this loan for X amount of a certain stock of a company through your brokerage, and you sell it to the open market. At a later date, you buy the same amount back from the open market and you repay that loan from your brokerage, while of course pocketing that difference. In other words, short selling is you are selling these stocks you are short or that you didn't really own, and then at a later date you are buying to cover that loan that you had out with your brokerage. So a situational analogy, I am married. My wife has a $4 ice cream in the freezer. If I were to eat this $4 ice cream, I would wait till a later date when this ice cream goes on sale. Say it goes on sale for $3. I rebuy the ice cream, same amount, same brand, same flavor, and I replace it in the freezer at a later date, thus pocketing that $1 difference. Some things to consider. Number 1, margin trading. So I spoke earlier about how shorting is essentially taking a loan out with your brokerage. I link this with margin trading, and I do this by explaining that you have to become a stakeholder. Your brokerage isn't just going to give you these shares to sell when you are not invested and financially liable to have to pay them back at a certain point. With margin trading, say you have to put down a down payment, 50% in this case, to cover possible losses. That's trading on margin. Putting that safety net in there with your brokerage in case the stock does go up, which you are short selling, and you don't have the funds to cover it. That's why you trade on margin. And this is where things get hairy. If you fall below those margin requirements, you may be subject to a margin call, and that is a big deal. If you are issued a margin call by your brokerage, it is important that you meet the due date. This will require you putting in more funds to cover these losses or liquidating securities and stock you may have in other companies in order to cover the margin requirements for your losses by a specific date. Failure to meet the margin call requirements can result in your broker liquidating your own positions without your permission to cover the losses, and that is to include the commissions, the fees, and the interest. Another analogy, You invest in a house and a car through a bank. Say you pay for the car outright, but you don't have enough to pay for the house outright. You take out a mortgage. 3 months later, you get laid off from your job. You don't have enough money to cover the mortgage. You missed the pay by deadline for the mortgage, or the margin call due date in this hypothetical situation. This would result in the bank coming to your house, taking your car, selling your car without your permission, and keeping a portion of the funds to cover the losses, the money you owe on the mortgage. And this goes back to the 5 fundamentals. Number 4, buy and risk. This is the all-encapsulating formula for that buy and risk, the margin trading, the margin calls, having enough funds, and the ability for the broker to liquidate your positions. Short squeeze, and why this is a big risk. Many people shorting a security or a stock or buying in a stock cause that rapid increase in price for a moment of time. This can lead to a lot of people who are shorting the stock panic selling or buying to cover, or just buying to cover their position, or being forced to cover via margin call. The interesting thing about all that is you could be like, this company's gonna decrease in value, you short this company, and then they have a short squeeze. You could be issued a margin call during this short squeeze and forced to liquidate your funds to cover your losses in this amount of time, and then say a brief amount of time later it actually does plummet. So you were correct, you just weren't correct fast enough. You see, with long-term investing in traditional selling, there is no ceiling, but there's a definite floor. With shorting, however, there is a definite ceiling, $0, but there is no floor, and that's what makes it extremely dangerous, because theoretically you can just continue to lose more money. Some other things to note: commission fees, for instance. Different brokers have different commission fees out there. I know Robinhood's allowed margin trading now. I don't know if they don't have any commission, but SureTrader, E-Trade, Ameritrade, all of them, they have different commission fees. So taking that into account, as well as your goals, short-term, long-term goals. What are you willing to lose? I personally never invest anything I'm not willing to lose. In the future, I'll be doing a video on the Security Exchange Commission, or the SEC, just to give a better newfound knowledge to a lot of you guys on what exactly that is, their role, and some tools you can use. However, in my last video, I went over budgeting, the fundamentals of it, some ways to budget, how to budget, tools to consider. So if you haven't checked it out, I suggest you do so next.